Thanks so much, David. So, hey guys, welcome. Thanks for joining in. Before we'll start, like always, when I start my presentation, I'd like to know a little bit about my audience. So if you can, guys, type in on your keyboard in the chat box, 1, if you already been trading for, let's say, 6 months and above, and 2, if this is your first 6 months in trading, just so I can get to know you a little bit better. So I see some ones coming in. That's good. Very good. Okay, great. And while you're doing that, maybe Ed, if you are trading Forex or stocks, indices, day trade, swing, so we'll have a little bit more information about you guys. Okay, so definitely the ones are winning right now. Mix between the stocks and the Forex, that's good too. Okay, great. Thanks so much. So today we are going to talk about how to buy the dip. This is probably one of the most important tools that you can add to your arsenal as traders. I will introduce myself in a second. Important for me to say is that whatever I'm going to teach you today, wherever we're going to talk about today, you can actually apply to all kinds of markets and assets. So whether if you're a day trader trading stocks, or you're a swing trader for stocks or Forex indices, it doesn't matter really if you trade in the US market or the European or the Asian market. At the end, everything that I will teach you today, you can take like 90% out of it and use it in your own kind of way and your own market that you've been trading right now. So, and I've been doing that specifically in the US market, but I did it in Forex and I did it in commodities and indices and stocks, obviously. So, so feel free to use the same idea, the same logic that we will talk about today. If you have any questions during the webinar, feel free to drop them in the chat. I will leave a few minutes at the end in case I missed some of the questions. So a little bit about myself. My name is Michael Katz. I'm the CEO of TradeOutLoud. We'll talk about TradeOutLoud in a second. I've been day trading for the last 15 years, day in and day out. 90% of my trading is stocks, but I also did some Forex, still doing a little bit of Forex indices mostly, and stocks, but mainly day trading on a 1-minute chart. That's my passion, my love, and probably I'll do it until my fingers won't be able to move so fast on the keyboard. Other than that, I was the head of traders in a big prop firm here in Tel Aviv. And during those years, obviously, I mentored, coached a lot of traders, saw a lot of them fail, saw a lot of them succeed, understood what makes a trader, a real trader, a profitable trader, and obviously through my journey as well as a trader. Besides that, I like to develop some tools for traders. One of the tools or the software that I've developed, we used in the proprietary prop firm that I worked with. Basically, it's a tool that managed the risk for the trader and stuff like that. So I'll also bring in that for a TradeOutLoud, and we'll talk about that in a second. Besides trading, I live in a moshav. It's like a small village. I grow my own vegetables, and that's also a great place to balance the rush environment of Wall Street compared to the living in the countryside. So before we'll dive in a little bit about TradeOutLoud, basically what we do is fund stock day traders. We're a brand new company powered by the Fivers. Some of you probably know the Fivers is a leading company in the Forex industry for funding traders. and we are a new brand of the Fivers. We have 3,000 stocks, a proprietary trading platform, and obviously as a prop firm, you go to a valuation phase. Those who will reach the goals of the evaluation of the program will get funded by us and can trade live and split profits and all of those things. So I will drop the link of the website, and you can go after this webinar, you can go check it out. If you like to trade stocks, day trading stocks, and even if you, again, trade in Forex, we do have some Forex traders that just shifting to trade a pool just to start trading stocks, because you will see today, I will talk about stocks mainly because this is my bread and butter, but at the end, the market is amazing today. We are at a period of time where the market is so volatile that we are definitely want to trade stocks, and in generally speaking, trading, because this is a great time for us. So let's begin. We are going to talk about a few things today. The first thing is, why do you want to buy the dip? Why you want to have this kind of arsenal, this kind of tool in your arsenal? This is by far my favorite strategy, the one that I will share with you today. We only have like 45-55 minutes, so obviously I can't go too deep into that, but I will try to cover everything. Try to watch the recorded video as well, so it will be more understandable, I guess. We will talk about the strategy. What exactly do you need in order to perform in real-time market, applying Fibonacci retracement to that strategy, so you can actually get around the area of 87% success rate. This is, again, by far my favorite and best strategy. I've been using it for ages, and probably this is one of the important things that we need to remember when it comes to trading in general. The market, a lot of people are saying that the market is changing all the time, but it's actually not really changing. It repeats itself in a little bit in different nuances, and we will talk about it in a second, and you will get my point. So Fibonacci, an Italian mathematician, popularized the decimal number to the Western world. Later on, Fibonacci sequence was invented. We won't get into that right now. It's not that important for us as traders, but we do need to understand that, and you probably, those of you trading at least 6 months and more, probably familiar with the terms Fibonacci retracement, and we use that. We can use that on a day-to-day where we trade in. Again, doesn't matter which asset or market we are actually analyzing. And I'm going to give you today, besides the buy the dips, I'm going to give you the twist that I've been using Fibonacci retracement with, not the classic one that most traders learned at the first like 3 or 4 months in trading. So why is the market, why did I say that the market is actually repeating itself and not really changing? And again, I've been doing it for 15 years, but if you go back 100 years ago, 200 or 300 years ago, you will see that the cycle of the market is pretty much the same, stay the same all the time. We have the disdain at the bottom, then a caution, then confidence coming as soon as the price moving higher. Then we go into the peak level when we are basically, most people are basically thinking that the price will continue higher and higher because they're getting into this euphoria stage. And as soon as that happened, the price started to decline. The hope come into play, the feeling of that the price, maybe it's not a major drop, maybe it will go again to the highest point and break through it. And then when we're dropping down again to the beginning of the trend, most people is in a shock and a fear stage, and basically saying, you know what, I'm not going to buy here, I'm going to sell. And when they sell to the other side that is ready basically to buy. So this cycle, a part of Dow Jones theory, Charles Dow theory, is a cycle that you can see all the time in any kind of assets, and also in every time frame that you want to test or analyze. You will see it today. We will talk about this, and you will see it on a 1-minute chart. But for those of you trading swings on a swing on a 1H, you will definitely see it as well. Yeah, exactly. Wyckoff or Charles Dow, pretty much the same here. So if we understand that the market is in a cycle situation, we need to understand, or we can understand why we want to buy the dip. Because at the bottom, obviously, there's some buyers coming in, pushing the price higher. And this is basically what they teach us, you know, from day one. You want to buy low and sell high. So there's only one kind of group that have been doing this, and these are the smart money versus us, as they call us, the dumb money. Now the smart money, help me here. Who is here in the smart money table? Who are the guys that are here in the smart money table? Okay, yeah. So we got the banks, institutional traders, exactly, hedge funds, great, yeah. Perfect. Big pockets investors, Warren Buffett's kind of ways. Not us, yeah, definitely not us. At least not me. I don't know, maybe one of you guys are in there in this situation as well. On the other end, they got us as retail traders, as the general public, and all of you guys that tip lovers. They were saying that as soon as you go to the taxi cab and the taxi drivers start to talk to you about stocks, that's the point when you want to sell your shares, because that's the cycle that we just talked about. Because those guys are coming from the bottom and started to buying from the guys that are selling. Because the general public, let's say, if I always give the example of 2008, because I lived in the States at 2008, and everywhere in the news, they told you, go and sell your shares, you know, Fox News, CNN, whatever. And that wasn't at the top at the end of 2007, but it was almost at the bottom of 2008, just before the end of 2008. So they didn't, the media didn't really told you, go and sell your shares when we were at the top. They told you when we were at the bottom. Now, if I'm going back to the first slide, the previous slide, if we are, let's say 2008, here at number 5, they told you, sell your shares. They yelled that in the media, sell your shares because the market will continue much lower, even here around this shock and fear phase. And as soon as, let's say I'm a guy that lives in, I don't know, South Carolina, and I'm not familiar with the market, but I'm invested in it, and I see someone telling me on Fox News or CNN, go and sell your shares because the market will collapse much more, then obviously I'm calling my broker and he's selling my shares. Now, when he does that and sell the shares that I'm holding, let's say 100K, basically from the other side of the table, there's supposed to be a buyer. Those buyers are the banks, hedge funds, and other institutional companies that are basically taking advantage of the psychological situation that we are in between the fear and the greed. And basically, that's what they do. How this is somehow they manipulate prices legally, but they manipulate the price basically using psychological aspects to basically telling us to sell while they want to buy. So if we understand that, from here, we can continue to the strategy and basically try to imitate the smart money and join them while they buying the bottoms and and most people will sell to us, and we will be the one who is buying the dip basically. So this is how the strategy is built. First of all, it's a counter trend strategy. So it's important to remember that, because some of you that learned through YouTube or other educators, most people say that you need to go with the trend, right? This is there's a saying, a sentence that's saying that your trend is your friend. So most people are looking to buy with the trend, but right now what we're learning is actually how to buy at a counter trend at the bottom. So in this case, mentally, it might be just a little bit tricky at the beginning, because you will see the drop, you see the price will dropping down majorly, and you're saying most people that will look at the chart will tell you that you need to sell, but you know that you are going against the wave, against the trend, but it will make sense, I promise you that. So you need to find an asset that is in a major downtrend, then reaching a major key level, wait for the smart money to manipulate the price, and then from that point go long. You can do the same, by the way, the same strategy. You can apply it if you want to go short at the top. So basically selling the top, you will see a major move to the upside. Then the price will reach a major support level, resistance level, sorry. You will see some smart money manipulation of that price, and we will get to that in a second. What exactly does it mean? And from that point, you will go short. I see you having a lot of questions, guys. I will leave it to the end, just so we can continue with the presentation, but I promise to answer all of your questions. If not here, then on our Discord or through our email. I will write it down later on. Okay, so these are the four assets that you need, or the four parameters that you need to know. One is how to find the right asset. Two is how to identify the key levels, volume that will come in, and the manipulation of the price. Now, again, I'm going to talk about stocks. So the right asset is basically what I'm saying is how you use scanners and stuff like that to find the right asset. We'll cover that in a second. But if you're trading, let's say, I don't know, Forex, so you have like 20 something pairs that you want to trade, you still need to find the right asset from those pairs just by finding the momentum on each pair. So basically, if I have, let's say, the euro dollar is not moving at all, and pound yen is dropping majorly down, then this will be the right one for me and not the one that is ranging. I hope it makes sense. So the right asset when it comes to at least stocks, we will use real-time scanners. So for those of you who trade stocks, you can use either from TradingView, or if you have a subscription for finviz.com, or obviously if you're using a trading platform in Tradepool, we have our own scanners, real-time, that you can use. If you use different brokers, most brokers provide you with scanners, and you can also customize them. what we want to see in that scanner is basically volume and movement. So, for example, if you watch the stocks today, so P. Diddy, one of the Chinese stocks, dropped down majorly. That was a great place to find it. I found it on the scanner because of the major move to the downside and also high volume that came in, and we'll see it in a second. And you can also prepared watch list for stocks that are usually that you usually watch for, let's say the big names like Tesla and Netflix and PayPal and other big companies that most of the time you will see them on the right track, like one-way street, until they will change their direction. So in order to find those assets, we will use those scanners, but we want to see, like I said, a move to the downside, volume above normal, and major gaps will be a great asset for us as well. For the key levels, we want to use the price action, obviously, as most of us know it. And also we can use indicators. So we will look for opened gap. That could be a great place for a major support or resistance level. So if a gap, we will see charts in a second. So if a gap is still open, when we'll reach that and close that gap, it will most likely be a support level. We can also use, if we're looking for price action, we can also use the second touch on a 1H chart. Again, here I'm using on a 1H, I'm looking for the key level for trading intraday. So if, let's say, you are a swing trader and you want to use them and you want to trade like a swing trade, you can go ahead and take a daily level or a weekly level in order to execute on a 1H. So my lines, my key levels are coming from mostly from the 1H, but I'm again trading it on a 1-minute chart. And the execution comes on a 1 minute. Other than that, you can use also intraday pivot points, let's say, and other indicators that can POC that can show you basically major support and resistance level inside of the day. 1H, 1 hour chart. The time frame is a 1 hour, and second touch is basically, we will see it in a second on the chart, but basically you had, let's say, one touch, the price dropped and reached $50, let's say, and then bounced from it, let's say, to 60, drop again to 50. That's the second time is touching the $50. In a minute, we'll see everything on the chart, and it will be more clearer than just talking about it. Don't worry about it. The volume that we need is, again, what I'm using in a 1-minute chart. You can use it also on a 1H or 15, doesn't really matter. And what we want to look for is increased volume. And this is one of the major things that you need to watch for and understand. As soon as you will see them, as soon as you will start looking like we're talking about today on charts, you will automatically understand much more. I can promise you that, because most of my traders using this strategy, and they saw it as soon as they learned how to do that. They understood the charts much better, a lot better than previous. And price manipulation. I'm also looking on a 1-minute chart. Again, this is just me. And what I'm looking for is basically patterns that will make a lot of people, a lot of traders, believe that the price will continue to the downside, exactly like the cycle we talked about. A pattern that will show them that the price should continue to the downside, but at the end, it will just be a manipulation part, because a lot of people will sell, so the smart money maker, market makers can buy at the bottom. So let's see some charts. Those of you talking about Fibonacci retracement, we will talk about it in a second. We'll reach that in a second. Don't worry. It's much important what I'm teaching you right now than the Fibonacci, but together with what we're doing, it will make more sense. And just give it a minute. Okay, so this is for one of the example. This is a 1 minute chart, news catalyst that coming in. So I'm using, obviously, as day trading, as trading stocks, I'm using catalyst as the news as catalyst to give me the right asset to trade on. It's like most of you are probably familiar with bull flag or bear flag, but at the end, I hear that some say that bear flags or bull flag doesn't work, not really working. And it's not that the pattern works, it's just that the asset that usually traders are trading on is not the right asset. So super important to find first the right asset to trade on. And in order to do that, we will use news. For example, in this case, it was news of the IPO of that stock. It reached a major support level and also made a nice momentum move to the downside. As soon as it's the support level, then it was the turnaround that we are looking for. And this is what we want to do. We basically want to buy those lows in order to get to that point where we're basically getting into the trade with the smart money and not falling to this trap. Look at this trap. You know it. Just before I'll show you that, try to tell me, why do you think it's a trap? Or where is the trap? Where is the price manipulation? Where is that price manipulation? Okay, so the price dropped down, bounced one time from their support level, went down again. Most people will see that and will think that the price should continue to the downside because there's sort of a cup and handle kind of cup and handle pattern that usually when people learn about cup and handle, they're saying it's supposed to go with the trend. So this is a classic way to bring you to the retail trader, to his face, show him a chart and basically telling him that the price should continue to the downside. And because of that, there's a lot of retail traders that believes in that and say, okay, if the price continue to the downside, should continue, let's take the break of that pattern, the cup and handle pattern. In that case, when they selling, when they shorting, someone from the other side is buying, and the buyers are the market makers, institutional traders, etc. Right here, let me mark it a little bit better. This is the pattern, the cup and handle pattern, the price manipulation. Basically, they creating this pattern in order to let you guys understand that the price should continue to the downside. Okay. So in this case, obviously, the big money buying it, pushing the price higher from 4.6 to 657 at the top. The time frame is a 1 minute chart. Right here. Uh, 170422. Hold on, please. Hold on. Trust me. All right. Major support level could be also a round number, like 98 at the bottom, price dropping down majorly. We're reaching a support level, pushing the price up. This is exactly what it looks like when you buy in the dip. Also, in this case, the price is dropping down on Tesla, creating a cup right here. Price manipulation. So a lot of people saying, wow, Tesla is dropping down. This is a nice cup. As soon as it will break the level, I will go short. But it's actually a price manipulation when it's reaching the $300 major support level. And look at the price change as soon as as soon as it reached that support level. Okay, yeah, I see. How do you know they are big players? Because this is how they work. This is exactly what they do. Big players are coming in at the bottom, selling at the top. They're not playing, they're not shorting at the bottom. This is not how the smart money works. And it can, and technically they actually can't do that, because when you want to sell a million shares, you can't really eat the bid and sell a million shares at the bottom. You want to sell at the top, as closest to the top as you can. So, and remember that you also need someone from the other side to buy or sell to you. So let's say you want to buy, a million shares, right? You can't really buy them. You won't buy them here because it's too high. Plus, if you want to buy them here, most people also want to buy when the price moving higher, right? We said that we saw the cycle, the euphoria part. So if a lot of people want to buy, who's going to sell to you a million shares in order to give you the field, So in this case, big buyers are coming in at the bottom because a lot of people are selling at the bottom. I hope it makes sense. I'm sorry for missing some of you guys' questions. I will try to answer everything later on. I will get back to those questions. I will leave like 10 minutes. Don't worry about it. Now look at the volume increasing again, same thing, dropping down majorly. This is a great trend, right, to the downside. A lot of people say, well, the stock is dropping down, should continue to the downside. But at the bottom, when it's reaching a support level, in this case, the $34, price manipulation, breaking through those tiny support levels right at the bottom. In those places, a lot of people are selling because they believe that the price will continue to the downside. They're selling here and they sold here, and basically moving the price further, and the price is basically decline. But at that moment, when people believe that the price will continue to the downside, then the volume start to increase. Why is it increasing? Because when they selling, there is someone from the other side that is buying, and that's the smart money that basically taking the position, saying, thank you very much for the great price that you're giving me. And that's it, pushing the price higher. So that's the manipulation. That's the way they are working. You can see it also here. And literally, you can see it every single day. And it doesn't matter, again, which kind of asset do you trade. Could be stocks or whatever it is. You will see those manipulations coming in. So for those of you who can't really wait, let's talk about Fibonacci for a second. The thing about Fibonacci that most of you are familiar with, and most traders all around the world, are those three numbers, right? The 61.8, the 50, and the 38.2. Now, those are good and fine when it comes to finding a classic Fibonacci retracement that looks like basically pullback, right? So let's say I'm looking at the NVDA at the moment. The price moved higher, then it pulled back, correct, to the 61.80 or the 50, held the support level, and from that point, most traders will look for an uptrend to continue basically the trend and buy around those levels. Now, what I'm looking for is actually a different way to trade Fibonacci, because this could work also. These pullbacks could work. Again, you can't really use just Fibonacci, and you can't really use just Elliott waves. It doesn't really work like this. There is no one strategy with one tool simply as that, and I can tell you that for sure. So you want to add parameters together. You want to, build this puzzle, and one of the tools that you can use is Fibonacci retracement. So if I'm going back to the buy the dip strategy, what we can actually do is use Fibonacci retracement in this way, the 23.6. So how does it work? Basically, we are looking for a downtrend, a major downtrend. We are dropping AMD, dropping from almost 102 all the way to 98, a $4 drop. Then we're looking for the support level, the major support level, in this case, the $98. A round number will most of the time act as support or resistance level. There's a psychological effect on it, and today's with AIs and other algos, it's basically the way they work. But let's say if we'll take it back 100 years ago or 50 years ago, an investor would call his broker and tell him, buy me AMD above $50 and not above 50.25, right? So a lot of psychological aspect in round numbers. We're waiting for the drop. We're waiting for the push to the upside. And then when it retraced to 23.6, then we want to enter. Okay, so we have the drop. We have the support level, a bounce up from the support level. And when it pull back, we don't want to take the 61.80. We don't want to take the 50, not the 38.2. We want to wait for the 23.6. Let's talk a little bit about that psychological aspect. Maybe you can guys tell me that. And I promise I will go through the questions that you're asking. Why do we want to wait all the way to the 23.6? And why usually the 23.6 works comparing to the 50, let's say, when it comes to buy the dip? Why do you think? Okay, I like the way you think. Yeah, it's definitely also a demand area, a demand zone that we come into to check again. It's closer to the bottom, right? Yeah, lower risk. Exactly. That's great. And also, I want you to think in a. Okay, yeah, some of you wrote that as well. Also, try to think psychologically wise when exactly running stop. a lot of people are looking at the drop. They're looking at the bounce, right? They're saying, okay, that's a great place to buy. And they buy in the bottom. But then when the price is pulling back, they saying, maybe, wait, something is wrong. The sales order are starting to fill in. And basically now that there are a lot of sell pressure from the other side, a lot of buyers are coming in and basically holding the price. So the more people will think that the price will drop, the more likely that the price will pop up. I hope it makes sense. The more people will think that the price will drop, the more likely that it will do the opposite, because this is how the market works. Otherwise, 99% of the traders would have made money. But at the end, if the smart money needs to move his shares, they got to work differently from us as retailers. Hey, in regarding the Fibonacci, like what I do, I usually, it doesn't really matter, it's the same, but I draw it from the top to the bottom just because I want to see what we call the Fibonacci extended, right? You see the 161.8 and the 268.8. So if I would have drawn it otherwise from the bottom to the top, I wouldn't be able to see the extended as well. But the price is, but the react is the same. The reaction is the same. So instead of 23.6, it will be 78.6. Yeah. Same here on Facebook, on Meta. Drop majorly to the downside, bounce up. When it bounce up, you wait. You're not buying on 68, you're not buying on 15, not 38. Wait for the 23.6. One of you guys I saw that wrote about what about buying at 50, starting the position at 50. Obviously, we won't talk about it today, but definitely there is an option to enter a little bit before that, let's say 50 or 38 too, with a small amount of shares, let's say 10% of your total risk. And then when it dropped, add another. Definitely, this is by far the most important thing that we have as traders is managing the trade. But we won't get to that right now. Drop into the 23.6, popping up all the way. And look how beautifully it held the 161.8, the extended Fibonacci, until reached again the 100% and move higher. I'm looking on a 1 minute chart, guys. Yeah, but again, you can do whatever you trade with on a 15, a 1H, daily, weekly, whatever you do, it's fine. The market is every market is pretty much the same, with small nuances that you need to understand. But the market structure, the psychological aspect, the cycle of the market is the same, applies to all. Tesla, dropping down majorly, popping up, pulling back to test the 23.6, going all the way up. Apple, same thing, dropping, popping, bouncing to the 23.6 and going all the way up. So basically, in most cases, for me, for example, I would buy already the dip, like at the bottom, and add more to the position around the 23.6. But at least at the beginning, now that you probably will go and try this, first wait for the 26, for the 23, and then when you feel comfortable with the strategy, start buying a little bit at the bottom, right at the bottom when it's reaching a support level, and then add a little bit more when it comes to the Fibonacci retracement level. We can also look at Oxy, same thing, dropping from pre-market, reaching a support level, bouncing up, retest it, the Fibonacci 23, and then bouncing up again. And this is the way, the right way, the easiest, I guess, way. Obviously, there are many strategies to buy the dip, but at least for me, that is by far the easiest way to find the bottom and then to buy and enter at the right place. Okay, I'll give a moment for those questions. In case I missed one of your questions, please drop them again in the chat box. Okay. Isn't the 100% up? Fold. I'm not quite sure I understood the guy that called himself 342914. Can you repeat it just a little bit? Yeah, we're talking about the 1 minute chart. Take profit, that's a good question, but it's a whole other story talking about take profit. In general speaking, you can definitely aim for the 168.8, 161.8, generally speaking. But obviously, if you entered at the bottom right here and your stop loss is, you entered at 23 and your bottom is at 0, this is when you're reaching 161, you are, I don't know, like 7 times your risk. So you probably won't wait all the way to the 161 to take the first partial. Definitely take it along the way. But again, we need good few more hours to cover everything. Yeah, you can do that in Forex as well. I did that in Forex. On Forex, I didn't use the 1 minute chart, but I actually used the 1H, 1 hour. Yeah, sell the peak is the same thing, very similar to that. And you can see that in this example, you can see it perfectly. The guy that asked for the selling the top. So basically, look at the volumes coming in here. That it's basically here, right? When most people are watching the stock, let's say Oxy, popping up, they're saying, wow, this should go probably much higher, right? But as soon as they think that, market makers that manipulating the price understand that, obviously, because they know more, they see more, they're more educated, they got more experience. And as soon as they know that most people are watching that and telling themselves that the price should continue higher, now they can actually sell their shares because a lot of buyers are coming in. And this is why you see the high volume right here. And you can also look for those pullbacks of 23.6 in Fibonacci retracement when it comes to selling the top. Yeah. Yeah, we can look at, if we have like 6 minutes, 7 minutes, so we can look at the SPY today or other stocks. I will go to the chart in a second. Okay, if I'm using other indicators besides the 23.6, what I usually use is, that's the only indicator that I actually use, is basically the MACD, like the MACD. You would look for positive diversion around that area. Again, I'm using a 1 minute chart. If I'm doing swing, I will use a 1H chart, 1H. And you will look for a positive deviation, a diversion here at the bottom. You can use also like RSI and other indicators that show you diversions. Yeah. Yeah, this is why I said take partials all the way while it's reaching the 161. Obviously, you don't know that it will reach that, So you should definitely take partials around that move. You know, in a classic way, you will take a 1 to 2 and leave some of it to run a little bit further and maybe reach that 161, or take some partial out, add more as soon as it's reaching like a pullback areas, and then if eventually you reach the 161, sell everything. The Fibonacci, you place it on the bounce up, right? You have the drop, you wait for the bounce up, and then you wait for the pullback. Let me go to the charts from today. We got like 5 minutes, so let's see what we have today. Let me pull up the charts. Okay. Right, so I'm looking at the Tesla at the moment, just a random chart that was here. As you see, this is a perfect example. Today we got a perfect example. By the way, I was on YouTube live today with some of our traders, and basically it was open to everyone. And we talked about exactly that before the market opened. It was a pre-market session, so you can go ahead and check it out as well. And what we talked about is that the price of the NASDAQ should drop down, and then when it will reach around that 12,000 on the NQ, the future, it should bounce up, and this is what we see right now at Tesla and most stocks as well. So this is what they did. The price of Tesla dropped down. They first manipulate the price when they let everybody think that the price should continue to the downside. This is not a coincidence. What you see here, this cup, right? This is not a coincidence. This is not a random price movement. This is a manipulation price movement. When they showing you that the price, also this bear flag, when they showing you that the price should continue to the downside, you are buying for this and you drop in the price and you basically selling the bid, volume coming in because a lot of people are selling. That way market makers can come and buy the dips, starting to fill in their orders right here. Price creating another cup. A lot of people are saying, wow, cup, Tesla is dropping down majorly. I will sell it, sell. From the other side, buy. Market makers are buying, volume coming in, increasing. And this is exactly what we talked about today. Just that. Obviously, everything not just happened on a random place. Look at the price when Tesla dropped to 266, a round number. So this is literally one-to-one what we talked about today. A round number, the 266, volume coming in, increasing, market manipulation, price manipulation, and then the price reaching higher levels. Now, in this case, let's take the Fibonacci. It didn't retrace too deep. It just did like 50% as I see it here. But let's take the Fib. What I'm doing is, since this is the bounce, I'm taking it from the top to the bottom, only because I want to see the extended Fibonacci. From the top to the bottom, in this case, as you see, it corrected to the pullback to the 38.2, didn't reach the 2360. So in this case, if you took some, let's say 10% risk around the 38.2, and then maybe add a little bit later on. In this case, it didn't reach the 26, the 23. But the whole strategy, the whole idea of the strategy was really flawlessly in this case, reached also the 168, dropped to 100%, push up. Look how beautiful it worked with the Fibonacci extended, 261.8, also dropped from that, and now reaching the 423. And today it's a great example, because if you go to other stocks today, because the Nasdaq did the same thing, literally any kind of stock in the Nasdaq that you will watch, you will see the same, the perfect same example as in Tesla right now. So David, that's regarding your question. Is your strategy based around scalping 1 minute chart? Again, you can use that in any kind of way that you want. I use it on a 1 minute chart. I'm not scalping. I'm holding. My average hold is around the 2 hours, so I'm not scalping. Let's say the last 3 years. If you like 8 years ago, definitely was a scalper, but the last 3 years, my holding time is around 2 hours, but I'm buying the dip on a 1 minute chart. Yeah. Going back to the wave 1, moving into wave 3, can you speak how you okay, so those wave, you mean? The volume changes is because a lot of people are looking at the pattern and saying that they need to sell because they learned from YouTube or whatever that this kind of pattern should be to the downside, continue to the downside. And in this case, the volume increases just because a lot of people are selling. And from the other side, a lot of people obviously are buying. So this is what we're looking for. Let me see if you have another question, but I see that the time is a little bit running out. Let me put first the email that you can send to us if you have more questions, in case I missed some of your emails. First, some of your questions. First of all, I'm sorry about that. Just the time is running out. So it's help@TradeOutLoud.com. But I'm watching. I'll try in a minute. I'll try to answer. Is there a certain volume level that you look for? The volume should be at least a double when it comes to increased volume. But you know, in most cases, you will see it. It will be outstanding volume comparing to the others, comparing to the 5, 10 before it. It should be right in front of your eyes, not something that you would think, is it then a higher volume than this one? You will see it like a 3-year-old will look at it and will tell you, yeah, this is a higher volume from the other one. How do we decide if that's the bottom? So this is what we discussed earlier. You want to first have the stock that is dropping down majorly, not just starting the movement, but dropping down majorly. Then you want to have the major support level, not just a random level or a tiny one intraday, but a major one coming from the 1H, a round number, maybe even a daily level, close of the gap, and stuff like that. Major support level. Those two elements will first indicate that the price should bounce. Maybe not, you know, change the trend completely, but at least you will see a bounce from it. And then when you will add the price manipulation and the volume that will come in, then you can be like very certain that the price will bounce from it. You obviously don't know how far it will bounce, but there's gonna be a bounce. Now, if you will wait, and not by the bottom, but wait to see the retracement for the 23, then you have more than 87% of success rate in this case. And if you want, you can also use diversion, like I said, with some of the indicators. I'm not using a moving average on volume now. Just, you know, you will see it in your eyes. Alrighty, guys. thanks so much. Again, if you trade in stocks and you want to join our program and try to get funded by us as a stock day trader, just check us out at TradeOutLoud.com. And if you have any questions, really feel free to drop them at help@TradeOutLoud.com. Any kind of questions that I might missed, again, sorry about that. And yeah, David, if you're with us.